Well, let's get cracking, shall we? This is the Money and Finance for Expats podcast on the 22nd of March, and coming hot foot from the recent, well, just now actually, the webinar on the macroeconomic situation globally is Paul Correa and Matt Penfold. I think they deserve a round of applause on this occasion. Great job, chaps. That was quite amazing.
To be fair to Carl, Carl, the great job goes to Paul. I was just playing the host, and as you know, that's a very easy role to do. So there wasn't much for me to do. So all on Paul on that one. Yeah, piece of cake, exactly. Yeah.
Carl, I'm still not here. I don't see myself. Not a big deal, but
you're going out perfectly. That may be a little bit off-putting and difficult for yourself there, but we can certainly see you. And if you talk to the camera, we're receiving you loud and clear.
No, it's just that I find it a bit strange.
Can you cope with that for the time being?
But why is that, Matt? Do you know?
I have no idea, Paul. I have no idea.
You might have to maybe reopen your tab on your browser to see possibly.
Okay, never mind.
At the risk of happening twice thereafter, but well done. You must be quite. How do you feel? Actually, how do you feel after that? It's like asking a footballer after a big match, isn't it? How do you feel?
No, I'm not sure it was being delivered exactly how I would have wanted, but I think there's a lot to cover, and it's very technical, and you kind of cover the same thing, so you tend to repeat yourself, and then you wonder whether you've explained it, as simple as you possibly can, but it's never simple anyway. It's a complicated subject, so you're left, whether you've lost the audience or not. And the whole idea, as you know, Carl, is to embed value and to give our clients, some value back. So I hope that's happened. Look, by the way, Carl, I've just seen this attachment. You said periods when to make money. Do you know this was given to me, and I have it somewhere because I never throw paper away. I have it in paper form over 20 years ago.
Yeah.
When I was working in banking financial markets, that same graph.
Is it appropriate to show it on the screen now? Would that
I think it's brilliant. I know I have it somewhere.
Right.
And I don't know where you've found that, but it's brilliant because I have seen it, and I remember the coloring, and I remember it very, very well.
Yeah.
So it's brought a smile to my face because it brought me back in time.
Well, here's the thing. One of the key messages of the webinar you've just delivered, and I was going to wind you up and say, so Paul, very interesting, but when is all of this going to happen? Because I know one of your caveats, and Matt was underlining this, is obviously nobody knows when, and if we did, we probably wouldn't be sat here right now. But this graph kind of it claims to say so, doesn't it? Ancient as it is, if I bring it onto the screen now, you'll see what Paul's talking about. The graphic style takes us way back, and it looks like it's from a newspaper originally, and that is available. I don't know how much we can charge for this sort of information, Paul. Only kidding. I mean, it is, but what it does point to is a spicy time in 2023, which of course is exactly what you've just been detailing. And when you set up your global macro look webinar, you had no idea, did you, that the SVB was going to collapse and Credit Suisse was going to be on adrenaline?
Carl, I prepared the material 2 weeks ago. Last week I was in Africa, in Ghana.
Right. Yeah.
So I prepared the material, and when I was in Ghana, sitting with a client late at night, and we both looked at CNBC and Biden was talking, I thought, and we were talking about investments, right?
Yeah.
And we just stopped to listen to Biden mumble some words about that would show up the financial system, load of rubbish, basically. And I thought, Christ, the material is now completely out of date. Yeah. So when I came back on Monday, I had to add a section on the collapse of the US banks and Credit Suisse to bring it up to date, because in September 2022, when we did our investment webinar, I said the elephant in the room was the US dollar rising too quickly and having an impact on emerging markets. In fact, I learned whilst I was in Ghana that interest rates in Ghana at 40% to stem capital flows. which is
Wow.
exactly the point I was trying to make 6 months ago.
Yeah.
And I said that was the elephant in the room, and the dollar has subsequently weakened because otherwise we would have headed to a deep recession. So that's no longer. This is like a meteoroid or asteroid heading towards Earth, and it can hit Earth, or you have to somehow break it down or deflect it. Yeah. So
Yes.
this dollar strength was an asteroid, and it's no longer the US dollar. Now it's systemic risk within the banking system because of higher interest rates, and the losses on short-term bond instruments as a result of interest rates going up. That is now the new elephant in the room, the new asteroid that could derail and save the planet or save the global economy,
Or not, as the case may be. And
or
so people
not,
are
as the
waiting
case may be. Yeah.
with bated breath. I mean, one I've got. I mean, please ask your questions. Those who are viewing, as we know you are. That sounds a bit ominous, doesn't it? We don't know your personal details. I just know that some people are watching this Q&A part post webinar. So if you've got any questions that were stimulated by watching the webinar, or just what Paul's been saying, and you want to pick up on that, please do. But the general flavour seemed to be towards the end of your webinar. Then is to stay patient and calm. Keep calm and carry on, I think was the phrase you used, Matt, and to take a long-term view, as I know you always suggest. And for people, whilst these this asteroid metaphor is there, despite all of that, and despite the turbulence of the current situation, to remain as calm as possible and to continue to take a long-term view. Is that about the gist of it?
Absolutely. I think traditional assets are losing value very quickly. We know the fiat currencies are losing value rapidly due to high inflation. Forget the headline rate. What our politicians are selling to us. We know, if you go to a supermarket or to fill your car with petrol, the real inflation rate is much higher than that. So
Yeah.
we know that. So fiat currencies are losing their value very quickly relative to gold. So it's not just a question of being patient. It's a question of having non-traditional assets, and more so, ones which, like precious metals, have historically done extremely well in an inflationary environment with uncertain times, with high levels of debt. History repeats itself time and time again, and gold will have its day, and it's coming very soon. We'll see a huge, eventually it'll break to new highs in this environment. And so it's not a question of just being patient, but making sure you've got the right assets at the right time.
Okay. I mean, can we go into the specifics of buying gold then at the moment, given that is a solid piece of advice, pardon the pun?
What is Carl, is a very good point, because if you look at very knowledgeable and very investors that trade gold, have traded gold for the last 20 or 30 years, they say one thing. There's nothing better than buying physical gold and then having it stored, because physical gold, you have it in your hand, right?
Yeah,
And if
right.
you even look at gold ETFs, even though they are secured funds and so on, we know that we have reason to believe that the banking system, for every gold bar that they have pledged, they are issuing, you know, there's 10, 12, how can I say, 12, 10, 12 certificates for every gold bar. So they're leveraged. So
Can I just ask there then? Have those rascals done the banking thing of fractional uh, lending effectively, but with gold instead? Have they done the same thing again?
I mean, the rumor is that they have lent more for every bar of gold. So rather than when they say ETFs are holding gold bars in certificate form, but how many people have a pledge against that gold bar? And they're talking about a multiple of 10, 12 times. So
Wow.
that could come to roost, and it could be a big scam.
Yes.
So ideally, you buy gold and you have silver and you store it away. I
Yeah.
accept that that's not for everyone. Then you have to look at the best gold ETFs. Failing that, and I think it's a very sensible strategy, buy the gold miners. The
Okay.
gold miners have traditionally in markets like this done a ninefold increase, a 900% increase.
Yeah.
And they are really at depressed levels. And the gold miners are gold miners as companies. So you could buy an ETF or have the gold miners instead.
Yeah.
And of course, silver as well. Silver does exceptionally well, but silver is more aligned to the general economy. So we
Yeah.
have a downturn in the economy. The first reaction, because silver is a monetary metal, but it also has industrial demand. So
Yeah.
the first reaction for silver is to drop in value together with traditional assets, bonds, and equities. But then it recovers and tracks gold and usually outperforms gold in a market where precious metals does well. So gold is the first one to take off, yeah, to
Mhm.
explode. And I think, by the miners, by gold ETS, with a caveat that there could be more claims on every bar of gold than they should. Banks are banks. They can make all kinds of pledges and promises, but their track record is not great. Yeah,
Okay. So the old timers, the traditionalists in gold, who say things like, if you don't hold it, you don't really own it. There is some truth in that.
exactly.
But as you said, that's not always practically possible, because then you have that brings with it new challenges, doesn't it, of protecting that asset when you hold it tangibly and really about your person or in your home. Understood, but certainly gold seems to be a good indication. I know you brought some questions, Matt, from the webinar. There were some to carry over, weren't there, from that environment?
Yeah, exactly. Yeah, I was just going to come in with that. So thanks, Carl. Yeah, the webinar. So Russell, who joined our webinar, had quite a few questions and comments. So I don't know if Russell joined us here for the podcast. Hello. But he seemed quite passionate with some of these questions by the language. So I just throw them at Paul, shall I?
Yeah, please do. Yeah, go ahead.
Throw,
So
throw me throw me under the bus, Matt,
throw
if you
you
want.
under the bus, yeah. Paul, when is
Yeah.
this? No, I'm not going to ask that. No. So the first, have the markets costed in the potential of things turning even nastier in Ukraine?
No, I think the market in probably in Europe and UK is priced to perfection. The US market is, I think I said during the webinar, is expensively priced relative to history. You look at price earnings multiples, so they are hoping for the best, and I don't think they have priced a rapid deterioration, whether it's the war in Ukraine or rising interest rates or an economic slowdown or a slump. I don't think they've priced in. I think markets are still, even you look at the US S&P index, it's dropped 20% in value from its highs. I think it peaked in November 2021. It's 20% down from its peak, but I think it's still very, very high and very high relative to history in terms of their pricing. So in answer to Russell, no, I don't think so. And that's why we advocate that we're very careful in terms of buying traditional equity markets. Yeah.
Good. And I've got another one from our friend Russell. This was at the end and ties in with our gold theme. Well, it's not a theme, but we were discussing it a minute ago. So gold smold is what Russell says. A year ago, at the same level, 1900, which we know is not quite right, but near enough, a rubbish investment. By contrast, Tesla at $100 in January doubled in 41 days. It's a no-brainer, says Russell.
I think Russell is mistaken. I think firstly, Tesla has gone down in value, as has Facebook and all the what do you call them, the fangs.
Yeah.
Even Apple, they've gone down quite significantly. I haven't got graphs or prices to hand, but they've gone down. Gold has held its value against, or even increased against yen, sterling, and euro, only against the dollar. I've said that patience is key in a market, especially when it comes to gold. But if you look at the value of gold, it always, it goes through cycles, and in times of deep uncertainty and inflation, it really takes off. But if Russell measures investments in time periods of a year in a market like this, then I think that's a wrong way of valuing assets in this market. I'm saying he's mistaken, and time will prove me right. In the same way that I had this discussion, my friend Carl will remember, with this German or Austrian lady. Do you remember the monetary theories and all that?
Yeah.
And she never took the challenge of having a, do you say tete-a-tete in
Yes. Yeah.
French?
Yes,
She
indeed.
she 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 avoided that, and I'm saying that time will prove us right. You can't measure, in periods of so much volatility just on a 12-month period and say, on this basis, my conclusion is X, Y, Z. I mean, it has no basis. There's no
It's
there's
interesting.
no
Yeah,
Again,
backing for that statement.
these are
yeah,
like top trumps, aren't they? Like investment top trumps. And it's a bit like comparing Roger Bannister with Usain Bolt, isn't it? It's like, well, you got to over what time scale or in what context are these assertions being made? Because Bitcoin people are especially good at this, aren't they? They'll give you a snapshot of an incredible rise of investment, and they won't talk so much about how it falls off a cliff occasionally. And then the crypto bashers will do the opposite, won't they? They'll pick their favorite bit of the graph to show you what a useless investment it is. But that's absolutely fascinating. On the matter of Teslas, apparently a survey by Car and Driver magazine found that 95% of all electric cars are still on the road. The remaining 5% made it home. It's a little bit of light relief
that
there.
that took us a while there, but it's
No,
interesting,
it's a
Carl.
lot.
Carl, it's interesting what you're saying about the way people measure these things, because
Yes.
if I look at Russell's question, and he said, Tesla doubled in 41 days. Now, it's a very peculiar measurement of time, and that suggests. And if I Google, the Tesla stock, which is very volatile, and just on the first, what you find on Google search, let's look at it over 1 year as a measurement, minus 40%. So this is a stock somebody's just told us is a no-brainer. Minus 40% in a year. If we say over 5 years, I think it's gone up huge amounts. Year to date, it's gone up quite a lot. But unless you've got that crystal ball that we've already confirmed we don't have, that's trying to time the market in a very volatile market.
Well, I think I now have a graph on my phone for Tesla. This shows how people can, their emotion runs their head, and there's got no basis, fundamental or technical, to back their assertion. You're right. Tesla peaked, I reckon, somewhere in November 2021 at $400 or whatever a share, and today it's like 200 from the graph I have. And look, it's 200, yeah, 197 actually. It's halved in value.
Yeah.
Halved in value, and they're saying that it is done really well. And the only way, in answer to Russell, I hope he's listening in and takes this in the way it's intended. The only way to look at this is to do a graph and have the Tesla share and the gold share alongside each other, to see which one has outperformed which. You can make all kinds of statements with no, economic or otherwise, or no data to support the argument. You're right, Carl. It's all about context and history, and also looking forward. Roger Bannister ran the mile in 5 minutes, when when human beings, their lifespan was shorter, they had less, their nutrition was, they didn't have as good nutrition. The soles they used to run were different. He was probably didn't even run with any shoes. How can you compare with 50, 60 years on? It's a totally different time in history. But what we do know is that gold has outperformed significantly Tesla shares since November 21. Of that, I'm confident, without a graph here in front of me. And I'm even more confident that he's mistaken in looking at it over 12 months. Even though the assertion is made is incorrect, you should never look at it over 12 months. I'm confident that over the next 2 or 3 years, gold will perform exceptionally well. Will Tesla shares do better over 20 years? That's a totally different question.
Yeah.
I think Tesla, so long as they dominate or the they got a good share of the market in electrical vehicles, might do extremely well. I'm not disputing that, but we're talking about specific time periods. The other thing, and this is purely anecdotal, I was on last Thursday, I was in London, and an old school friend of mine picked me up on his car, and I said, David, wow. I said, there was no noise. He says, it's an electrical vehicle. It was a BMW, and there was no noise. It's like when you get onto, the new planes, BA, British Airways planes, they've got ultrasonic or whatever it is, no noise on the car. So, yeah,
Strange
just
experience. Okay, so we won't be buying
strange.
that book by the sound of it, the 41-day investor. That'll be. You can see that on Mad Money, on whatever channel that's on, sometime soon. You made a really good point at the beginning of that, Paul, about bringing in, and I think this is what's gone on here, isn't it? If you are a Tesla owner, or you're a fan of Tesla, you would want the share price to do well. That's not a very good driving force in investment, is it?
Absolutely not. You have to be cold and look at the data. Yeah. As I
Yeah,
said, Tesla might well do extremely well long term,
yeah,
but we're not talking about long term. I mean, Russell makes a statement there and says Tesla has done exceptionally well, blah blah blah, and gold has performed poorly. When in fact the facts prove otherwise, and this is where emotion runs the head, yeah, rather than the other way around.
yeah, yeah, absolutely. So don't just invest in your hobby because you love it. Look at those cold
Exactly.
hard facts. I think you were going to add something there, Matt.
No. I've got more questions for my friend Russell, so I
Oh,
can
excellent.
keep
Yeah,
it coming if you want.
please do, please do. Yeah,
Is that
I
a
mean,
busy morning?
you like the cut of
There's
his jib.
Yeah, there's one more. And this one makes a good point, I think, in some respects. So I don't know where this question derived from, but indices are a mere average of wildly different stocks. I think we can agree with that. Investing, in inverted commas, in the FTSE Dow, Nasdaq indices is a lousy investment strategy. Look at what's cheap: oil, miners, gamblers. I just bought 888. Look at the chart. Retailers are fragile. Banks are bouncing. Barclays up 19.7 in 3 days. Now, I think Russell's taking his kind of short term view a little bit there at the end. But I think he also makes a kind of good point in the sense that just looking at, okay, everything's overvalued or everything's overpriced, and it's looking for value in the market. Would that be fair?
Well, I agree, but that's what we're talking about.
Yeah.
That gold has a lot of intrinsic value in this environment. We are value-based investors because we're not in a growth market. We know that. We are in a contracting or sideways or in a stagnated environment. We've got stagflation. So in this market, you don't buy growth stock, you buy value stock. But that's what we're saying. But Tesla is not a value stock, arguably. Tesla is a growth stock. So I mean, there's a contradiction of sorts there in his statement, right? He's talking about finding a deep value in stock, which we agree, but then on the other hand, he's buying a growth stock, which is Tesla. That doesn't make sense. And the other thing, Carl, worth discussing is he talks about the banking stocks making a rebound over 3 days.
I was going to ask you about this.
I mean, this is
Yeah, you can't add too much importance to that. They all have these dead cat bounce, don't they?
but do you know why there's a bounce in the banking sector? Because UBS stepped in to save Credit Suisse.
Yeah,
For now, the US banking sector, there's no other bankruptcies. They've
for
kind
now.
of sold the idea that they're going to shore up the banking system. There's not enough money to do that, but that's the message from the US government and so on, that they're there to support the financial system. And of course, the banking sector bounces over 3 days.
Yeah,
What does that tell you? But Russell ignores the previous week when banking stocks were battered.
yeah.
So I mean, he has to excuse, and Russell, please take it in good spirits. He has to put his glasses on and look at it. He has to be a discerning investor and look at things rationally and fact based rather than emotionally and picking periods that suit.
Yeah.
I think there's a bit of being a hindsight investor there as well, which we're all brilliant at being a hindsight investor.
Yeah.
Let's Google
Absolutely.
what went up last week, and let's say that we tipped that a week ago. But I think we spoke about the banks last week, didn't we, Carl? In the sense that they had this collapse, and for those people who want to trade, there could be an opportunity, but it's a huge kind of risky thing as well, and you can kind of fall either sides of it, and really that's not for us.
Well, and there again, context is all important, isn't it? Because you're very clear about how you want to see and support people when it comes to investing. Russell, of course, may do it for fun, and that's perfectly legitimate, isn't it? To have a bit of a flutter and to take a fun approach to it, which is an entirely different pursuit. He may not be looking after other people's money. He may just be having a bit of fun with his own.
Well, it's a very expensive hobby in this market. That's what I would say. That's my first
Yeah.
reaction. It
All
could
right.
turn out to be an expensive hobby.
Yeah.
So
Okay.
I think tread with caution. That's my advice to Russell, because this is not a market for a novice. This is a market that you really need to keep your nerve
Yeah.
and leave emotion to one side and know what you're doing. Don't think you become an expert because you dabble in the market. And if it's small amounts, that's fine. But if
Yeah.
he's investing his own capital, he might get his hands burned if he doesn't know exactly what he's doing and he has some knowledge but not doesn't know everything, right?
Okay. Do we have some dates from when things are going to happen from Russell as well, there, Matt?
He'll tell us next week what happened this week.
Oh, Russell, if you're watching this,
It was, take it in the best way, Russell,
yeah,
because we actually appreciate the questions. We ask people to engage, and there's some good points in it, and yeah, it's we all have kind of different opinions, and we have ours, and I think you're right. Maybe Russell's approach is slightly different to us, and I think it's the same with we spoke about cryptocurrency before. People maybe do it as a hobby of sorts, and I personally I wouldn't touch it, but other people do. But you need to go into that with your eyes wide open, and be aware that okay, maybe there are potential gains there, but also there's a big amount of risk, and you should only be using money that you can afford to lose.
I found a bit down the back of my digital sofa. Actually, I was looking at an old wallet and found some Bitcoin that had grown a little. It's tiny amounts, hobby amounts. But you're absolutely right. If I was relying on it, it would have been pretty disastrous. But it was just a nice little pleasant surprise to find it there, and it wasn't taking up any space when it's your digital sofa. Were there any other questions for anyone else? Thank you, Russell, for that, and thank you for us having a bit of fun with that. But as Matt says, all questions are welcome. It can be very educational and helpful to other people as well. Any others you've brought over from the webinar there, Matt?
I think that's all we have from the webinar for today. So I always say it because as you know, Cole, we run quite a few webinars. Today was the big investment one. We've got a couple more tomorrow, which are based. Actually, it's nice of us to put a good opportunity to promote those here, because we're talking about the Spanish and Portuguese bonds. We did our reveal a couple of weeks ago about the offer, but we're going into a bit more detail about those. So feel free to join us with those. I think I had a point before I started to promote those, Carl, but I've completely forgotten what it is. But
this is where people can sign up, right? Your website, fiduciarywealth.gi. Perhaps before we conclude, you were talking about it's important to look forward as well, Paul. And yes, certainly looking forward will be the key dates of when you've got other webinars coming up. So let's have those by all means, Matt. But Paul, looking forward, the Fed Wednesday. Are we
Today.
it's Wednesday today, isn't it?
Today.
I can't keep up with this pace, quite frankly.
Today, in the next hour or two, we will have a release
What are
by
we waiting for? What are we looking out for?
we're looking for a decision on interest rates, on US interest
Right.
rates, whether there's going to be an increase or not. So it's going to be fascinating, because that'll be critical. The market was pricing a rate increase 3 weeks ago of 50 basis points, 0.5%.
Yeah.
2 weeks when the US banking crisis erupted, then Now they're talking there's probably a 50% probability it's only going to be 0.25%, 25 basis points. Some in the market, less than 20, think they might actually even pause. So the Federal Reserve cannot afford to get this wrong. They cannot afford to come in too strongly and raise rates because it could derail the US banking sector and we could have more bank failures. Remember, they're holding, US banks, all banks hold, invest their capital in short term instruments, you
Yeah.
know, treasuries and mortgage backed securities. And those are adversely impacted by rising interest rates. So they suffer capital losses. It means their capital buffer comes down and puts a strain on the bank. So the Federal Reserve has an important decision to make. And if they go in too strongly and they stick to a 50 basis points, the market could very, very, react very badly to that.
Mm.
Consensus, everyone's thinking it'll probably be a smaller increase of 25 basis points. I think that's the expectation. And then they made surprise by being more dovish in their approach and pausing rates. If that happens, that would be a spur to the stock market. Yeah, the stock market would probably rally on the basis that they can smell not just a pause, but potentially that they start reducing rates anytime soon. So it's going to be absolutely fascinating. And Carl, I said something 2 weeks ago, I think it was, and which brought a smile to your face, but I'm going to repeat today, and because I think it's relevant. In a market like this, you don't follow the herd. Yeah, you take a contrarian view, and that's where you're going to make alpha excess returns by taking a contrarian view, which is what we're doing. Because as I keep saying, if you mimic the herd, you revert to the mean,
Mm.
to the average. And in this market, if you follow the herd into the wrong market, your returns are going to be no different to the crowd. Yeah, in a crowded market where everyone's selling, so you can't afford to make mistakes. You have to be so careful, so
And
so careful.
I imagine Jerome Powell then is pacing up and down, ready to make this well, highly anticipated speech. If you two were in the room with him, in the dressing room or wherever he happens to be, a boardroom where he's getting ready to do this, what would you be saying to him? What would your hopes be, and what would your advice be to him?
If I was one of the Federal Open Market Committee members,
Yeah,
my advice would be to pause rates and increase quantitative tightening, which is the amount of money which is being drained from the system.
yeah,
Pause the interest rates and just increase the amount of liquidity the Federal Reserve is draining from the monetary system. It's today at a rate of 90 billion. I would increase that to 120 billion. Yeah, something like that, 150 billion, and say we're draining system, but the rate cycle is over. It's another way of um, uh, keeping tabs on inflation without raising interest rates. I think the policy is restrictive enough in a market with too much debt and where banks, the US banking system, is terribly exposed because they hold their capital in bonds and those bonds are being decimated by rising interest rates. That's what I would do. That would be my advice.
that's a
Pause the
good
interest
number.
rates
Yeah,
and start draining more money from the system by increasing a quantitative tightening from 95 billion a month to 125 billion a month. But stop
right.
those interest rates, because what we don't want is systemic risk within the US banking system and the global banking system, because that would take us back to the global financial crisis and a deep recession, which involves more quantitative easing and more debt.
Yeah.
Surely
Okay.
we're going round circles. So we need to engineer a soft landing in the global economy, the US economy and the global economy. Stop the rate increases because it's not sustainable. Work on the quantitative tightening for now, and it's a slower process, but you're still draining money from the system, and it still has its impact and its effect on inflation.
How
That
many
would be
people are on this committee, Paul?
I don't know. I don't know if it's 8, 10. I don't know how many governors there are. Matt, would you
I
know?
thought it was 12, but don't
It's
hold
12.
me
It
to
could
that.
be.
Yeah, yeah.
There's
It's an
12.
amazing position to be in, isn't it? And as Jerome Powell fixes his steely gaze upon you, Paul, and says, "Thank you for that. If it turns out to be true, I'll take the credit. If it turns out to be wrong, I'll be making sure it's attributed to you." And then he turns to Matt and says, "Matt, what have you got for me today? Would you agree with that? Was there anything you would add or not, Matt?"
It's a difficult one, Carl. I mean, you don't envy them making this decision
No
because
way.
I think we've said it before. You know, they're what's the saying that they're caught between a rock and a hard place.
Yes.
Um, I think they will just go 0.25%, and to be honest, for me, it's a bit of a cop out. I think they're delaying because they're not really going in kind of one way or the other, really, and I think it almost feels like sometimes they're waiting for something to happen rather than them lead it in that direction.
Yeah.
They've been desperate for inflation to naturally come down for some time, and it's not happening. And I think maybe they still hold out some hope that it will, but I think they will take the um the middle option, A, B, or C. They take option B, which is the 0.25%, but we will see. But not, I'm not saying that's my advice. I need to caveat that.
I and
If he's
I,
watching,
Yeah, and
I
just in case he subscribes, yeah.
I think the headline would be to make or not to, sorry, to break or not to break the economy. Yeah,
yes. Well,
that is the headline now.
quite a responsibility. That will take place today, of course. And are there subsequent and other decisions as we look towards the future that will be pivotal and crucial as well? Other meetings, other authorities making pronouncements.
I think, look, the U.S. central bank, the U.S. the Federal Reserve, um, signpost and provides leadership in terms of monetary policy. So
Yeah,
whilst Europe and the UK might steer a different course, in reality, all eyes are on the Fed today because it's still the largest economy, it's the most dominant. The dollar is the reserve currency of the world, or that might change, as we mentioned earlier. And I think, all eyes on the Federal Reserve, all eyes on Jerome Powell, a lot of pressure to make the right calls.
hmm
And we know from the past that he's made wrong decisions during the COVID crisis. And now things are getting tough and difficult. Will he hold his nerve? And Matt said, I mean, you both mentioned A, B, or C. 0.5%, 0.25%, or nothing. I go for C with a caveat it's zero, but increase the quantitative tightening and drain more money from the system and pause the rates. That's what I would. So I'm a
Well,
C and Matt is a B.
next week, then we'll come back to this next week. I've got a question. You may not want to go here with this, with the time we've remaining and with the scale of the question. But you say history repeats itself, and that it's the biggest economy, and the dollar currently is the favored currency of the world. Um, so if we look at history, I mean, that wasn't always the case, was it? We could call it prehistory, couldn't we? When that wasn't the case. What empires do we go um, to see what happened last time? And what are your predictions for the next one? Because it won't always be the case, will it, that the dollar will be the preferred currency of the
No,
world
no, no, no,
and that
no, no.
America will be the biggest economy? Can we have a little bit of a history lesson and a bit of a forward projection then on that?
Well,
Or
I
is it
haven't got yeah, I haven't got any graphs or data to hand, but you're absolutely right. If you go back to the history books, because they always teach you a lesson, there've been dominant currencies over time, over history, going back 500-700 years, and they normally their period of dominance is no more than 100 years. So, and the
okay?
dollar is approaching the 100th year anniversary, or is already at 100 years. So we
Yeah,
had the Spanish peseta, surprisingly,
really.
extremely dominant. Yeah, the Portuguese escudo. I think we had the Dutch guilder. Remember, these were very dominant global
Colonial powers,
countries.
of course,
The very
and no doubt,
powerful,
the British
uh,
pound or
and the
guinea, as
and
it might have been.
and the British pound.
Yeah,
So over time, there's always been a currency that has been dominant, and the US has had 100 years of dominance, but we already know that the BRIC economies want to break the dollar dominance and the dependency on the dollar as a reserve currency, and they're engineering and working together to bring to launch a new currency, yeah, that is going to overtake the dollar as the reserve currency of the world. I mean, it's happening now. They want to de-dollarize. So it's a very good point. I think we're getting to an end of a cycle. The dollar's days are numbered, whether that takes 2, 3, 5, or another 10 years, but we're heading in that direction. And I don't think it'll be too long before, with the changes that are happening, on digital currencies and so on, it won't be too long before the dollar loses its dominance. But if you ask for a time frame, it's impossible. But certainly within the next 10 years, I wouldn't be surprised that the dollar has lost, if not completely its dominance, but is no longer won't carry as much weight as it does now. Yeah.
And it could be a collective coin rather than a single nation coin.
I would expect it'll be the BRIC economies building a coin as a collective group, and then the rumor is that then they will have their reserves in gold to support that currency to maintain it strong.
That's
so
where
I think
that's where it's all going then, maybe.
That's where it's going.
So is it the briquette or the brick coin, or what's it going to be called?
The BRICS, I think right now is Brazil, India, China, Russia, and South Africa.
Yeah.
And potentially with some Middle Eastern countries maybe thrown into the mix.
How fascinating. How fascinating. And these things don't happen overnight. It's not going to suddenly be introduced like the euro, is it? This is going to be a gradual process of dominance. And change, of course. Thank you for permitting me that question, because it is slightly it is of a different scale and order, isn't it? And quite, I suppose, terrifying for us, having been privileged enough to live within the influence of the pound and dollar, and having that as our currency, literally, that we can refer to, and we're friendly towards, and it's friendly towards us.
Yeah.
Different times ahead. Thank you both so much. So we'll see if your Fed predictions will be true or somewhat modified after Jerome Powell hears your counsel, when we return next week for the webinar. And look forward to your company again. And thanks to everybody who's tuned in today. Don't forget, you've been very quiet today, not asking many questions. We thank Russell for his. And we know people have been watching today, but have been a little bit reluctant. Don't be shy. With your questioning, do ask your questions while we're live on air, and we'll have some fun with that as we did today. So enjoy the rest of your day. Thank you, Paul. Thank you, Matt. Anything else to add before we go?
No.
You deserve a rest, Paul, quite frankly. So a nice big lunch in Gibraltar is certainly what you deserve. Thank you very much for being here today. Bye for now. See you next week. Ciao, ciao.
Thanks, Carl. Bye, everybody.
See you next week.